Let's talk about what is going on with the market. What are we seeing that's different this time? We're starting to see the tech stocks, the AI stocks. They're not going back up. They're not, usually we see the minute that the stocks drop, they turn around and go right back up. Why? Because you have the FOMOs in there buying, right? Those are tourist investors. These are people who don't know what they're doing. They're just total gamblers, and they never want to learn, and they buy on emotion. So what's happening is every time the AI stocks would drop, and they were dropping because, again, the big hedge funds, the big institutions started to dump them in April because they're dumping them to cover their margin debt. And what happened was, again, we were told that the tariffs were not going to affect anybody. Well, they did. The tariffs of 10 to 18% affected a lot of stocks. So the hedge funds who had these stocks, when the earnings came in, they were poor because of what happened between that 10 and 18%. The earnings weren't there. So the stock prices dropped. So they got big margin calls. But we've only heard that, oh, don't worry about tariffs, not going to hurt anybody. Well, last week, President Trump even came out and said, I'm thinking about sending a check to every household of $2,000, the same thing that we did back in COVID because of how people got hurt because of these tariffs, which contradicts the other side, right? So there's other things that are going on with these AI stocks. One of the problems, and we've heard early on, was the returns aren't there for the amount of money that's being invested. And we started to hear rumbles of that. And then we started to hear about how the prices of these stocks are higher than earnings. That was a big worry. And then we're hearing that the AI stocks are not following the accounting rules. All of our companies, we are under the same accounting rules. You have to take depreciation as an expense. Now, anybody who sold the business, you know that because you say, okay, my business, I made $500,000, but I really made $600 because I want to point out here, look at the depreciation. You can add that back. But it showed less profits because you have to depreciate. Well, that's not what they're doing. We're finding out now that because the earnings are, the stock prices are larger than the earnings, they're now saying, well, we're not going to follow the accounting rules. Now, this just started. So they're predicting, if you take Oracle, for an example, between 2025 and 2026, when they report 26, their earnings are going to be up 26 to 30% more than they should be. And all the AI stocks, and they're worried that, oh my God, over a 2-3 year period, we could have a big bubble. Another thing they worry about is they're borrowing a massive amount of money. They're leveraging to power up their data centers. They don't have money to do that. So they're borrowing heavily with the idea not to worry because we'll get the government to bail us out like they did with Solandra. And as you know, Solandra, we got hit, you and I, taxpayers, $535 billion. I'm only pointing this out to you because you're starting to see, when you look at your tech stocks, let's take a look here in my chart. If you just look at NVIDIA, for example, I mean, how many times you ever see NVIDIA break like it's breaking and not go right back to the top? Seldom. Or how about ARC? You would always break and go right back to the top. But you're not seeing that. These are pure shorts. Matter of fact, My gang, we're short ARC. Got a nice short right here. Broke support. We haven't seen this before in these tech stocks. So that's because going back to April, when all the hedge funds got hit with margin debt because of the tariffs, and the companies they were in, stock prices were going down, so they got hit with a margin debt. They started to sell off their AI stocks because they didn't like what was going on with the AI stocks. So they were selling them anyways. As a matter of fact, 6 months before they got caught with these margin debt, they announced they're not going to be buying these AI stocks, not as much as they have been, because they're worried about them. So that's what's going on. The other thing that's going on too is this. QT. Now we know what QT is. QT has been since 2022. So QE, remember, has been since 2008. QE, they increase the money supply. They just simply go in and print money, take the money, and they go buy 10-year treasuries. But before they do that, the Fed drops their rate as low as they can, near zero. And when that happens, it influences the 10-year treasury yield. Now, it doesn't control it, but it, again, influences it. And so the 10-year treasury yield would drop. So QE was a way of getting those 10-year treasury yields down, which is very important because they hit your mortgages, your credit cards, everything you do, business loans. So the lower those yields, the less interest you pay, the more profits you make. So QE, they kept this QE going for too long. It causes tremendous inflation. It causes a weak dollar because of all this money printing. So in 2022, we find out that inflation's hitting 9-10% in the election year. So they had to get rid of that. So Powell then introduces QT, which curbs the inflation, reduces the amount of money supply, just the opposite. Now, you heard of late, in October here, how the banks that loan to each other at night have no money to loan to each other. In 2008, when that happened, we had the 2008 crash. Well, that doesn't happen anymore because what happens this time, which happened in October when the banks had no money to lend to each other, Powell pushed together a group of investors and pour money into a bucket, and then they give the money to the banks. So what's happening is that they've kept QE so long now, too long, causing tremendous inflation, and it caused this big rally, weak dollar. They've got to stop. So they're going to stop with QT, curbing the inflation. Remember, QT is the opposite, and it reduces the money supply, as I just said a moment ago, and it can cause a crash. Instead of a weak dollar, you got a strong dollar. So by reducing the amount of treasuries on the Fed's balance sheet, $60 billion a month, and remember, that in turn reduces the amount of money supply, the amount of dollars in the economy, causing a demand for dollars. Like these banks, they need a dollar. So what does that do? That causes yields to go up. When you have less dollars, interest rates go up. This is all to curb inflation. This is going to end in December. Now, he believes that this is going to work, and he's going to turn around and bring his Fed rate down, and then he's going to be able to, with the Fed rate coming down, the 10-year treasury yield will drop under 3%, and then China, Japan, and UK will start buying treasuries from us again. No, they're not. And he's never going to get down there. He's not going to get to below 3%. He's going to panic, and he's going to turn around and start QE again. That's when the market will really crash. So what we're seeing right now is this. All these tech stocks, we have not seen this before, where you get these big corrections like you're seeing, and they're not going right back up. So, shorting, okay, is what you need to do. And we have some tremendous shorts on. Okay, we have ARC, which we're shorting. The trend's going down beautiful. Look at the trend. And we're shorting NVIDIA, of course. So we got a lot of good shorts on. The other thing you got to look for in a market like this, you got to look for stocks that aren't going down, that have relative strength. And we're doing that too. So give you an example, the banks, like JP Morgan. Sure, it's pulled back, but notice the difference between JP Morgan and in a tech stock. Okay, JP Morgan's doing, it's pulling back, but if you look at the mags, what you're seeing, the difference, and I'll pull it up here for you, just give me 1 second. Okay, here you can see the Magnificent Seven, okay, as they start pulling back, let me just get this for you again right here, they start pulling back. Once these Magnificent Seven broke the 50-day moving average, which they did today, they'll soon turn red. And when they start turning red, that's when these things are going to break. Intel's another one. When it breaks that 80%, breaks that 50-day moving average, they're going to break. Now, when all these stocks that still have relative strength, that hasn't turned red, that still have, again, the market's going down big, but they're not going down with the market. As soon as they start breaking relative strength, and they catch up with NVIDIA and ARC and all these stocks, right? Qualcomm, then those last holdouts will panic everybody. And then there'll be a flood of selling. So, but again, if you're a smart trader, you'll be looking for stocks that have relative strength. And that's what we're also doing. So you're going to be looking for stocks like Lilly. Okay? So the point is this, that the stock market has been enjoying QE for all these years. And then they stopped. But the stock buybacks continued. Now there's a problem with inflation. QT has been since 2022 to curb inflation. But now he's got to get rid of QT because all the dollars are gone. The banks are in trouble. They don't have dollars. They have to keep getting the Fed to put a pool together. So the bottom line is this, that this QT is not going to work. Everybody knows it. So what do you do to protect yourself? You got to learn how to sell short because there's no place to go. You can't hide. You can say, I'm going to buy Coke, I'm going to buy Clorox, but you have no place to hide. You got to learn how to sell short. Once you learn how to sell short, you don't care if stocks are going up or stocks are going down because that's your protection. That's your insurance policy. 90% of people lose money in the stock market because they don't know how to sell short. It's just that simple. So that's what has happened. That's why you're starting to see these big tech stocks break down. And once they end QT in December, they feel they've curbed inflation. That's going to be a big mistake. He's going to go back to QE, and then I think that's when you get your big crash. I do not think we're going to get a big crash right now. I think we're going to get another rally, one more rally before we have that crash. My guess is when they do the QE again, that's when you got the highest probability of a crash. But again, we'll keep watching our signals. The one beautiful thing about the market, it sends you messages. And as long as you know how to read the messages, you'll always know when the market's going to correct. Well, that's about it. So enjoy your weekend. And let's see what happens when Monday comes. And keep your eye on that, again, on that dollar. And keep your eye on that QT, okay? And we'll be all fine. For help, go to philsgang.com. We'll teach you how to go long and short. That's your protection. See you on the charts.